the repo market originate? Well, we've got a chart right here, and it goes from 2% up to 10%, and this is the amount of interest that the repo market is charging. That's the going rate, and this is an annual rate. We start here September 3rd, we go to September 18th. Starts off along, nothing's happening here, nothing to see, don't worry about this, just business as usual. And then all of a sudden we get to about the 15th to the 16th and it just spikes, boom, straight up. And this is incredibly unusual. We go up to 6%, it goes back down a little bit, and then it spikes all the way up to 10%. So what was happening here and why these rates spiked up is because some of these banks said, okay guys, we need cash, we need cash. And the money market guys said, no, I don't think so. And the banks are like, wait a minute, we have to have this cash. Okay, fine, we'll give you 3%. And the money market guys said, yeah, I don't think so. Okay, fine, we'll give you 5%. No, I don't think so. 6%? And they said, okay, fine, we'll go ahead and do the transaction. And then what happened the very next day, or maybe it was the same day or a couple days after, is they had this exact same problem where the money market funds didn't want these bonds, or they didn't have enough cash. One of those two happened, and the rate spiked way up here to 10%. And then the Fed came in, they saw this emergency situation, and they printed up a ton of money like they always do, and they went right into this repo market. So now we've got the Fed. They print this money, inject it into the repo market, so now the money market funds don't have to provide this cash. They can go ahead and do this, they meaning the Fed, can do this swap with the banks for their collateral, and all of a sudden the rates go all the way back down to 0 and then pop back up to where they normally were at 2%. Here's a timeline of the Fed's repo operations per their website. You can check it out at the New York Fed's website for yourself. But initially they came out and made these announcements September 20th. This isn't when they started the repo operations, just when they announced it on their website. And they said that they're going to do these term repos, which means the repos have a specific date on them, of 30 billion plus, and that's going to end October 11th. The overnight repos, that's just that overnight transaction, is going to be 75 billion plus. That would extend to October 10th. Well, sure enough, on October 4th, they came out and they upped the term loans from 30 to 35 to 45 billion, and they're doing it till the end of October. So you see what's happening? The amount of money is increasing, and the length of time that they're committing to is also increasing. Going to the overnight repos, that's still at 75 billion plus, but now they've extended that from October 10th to November 4th. They then came out on October 11th and said, okay, we're keeping it at 35 to 45 billion plus for the term repos, but we're extending it to January. So from the end of October till January, and they're keeping it at 75 billion plus for the overnight transactions, and they're extending that to January as well. One thing that shocked me when I was actually reading this, because I haven't really heard this anywhere in the media, but if I was reading this right, they said that they were starting to buy 60 billion worth of treasuries starting in October 11th. This is huge. The reason why, technically, they're doing repo operations, which means they're buying that collateral from the individual bank or from the borrower, but that borrower is committing to buying that back from them at a specified time. Where here, the Fed's just admitting that they're buying these long term, and it's going to add and increase their balance sheet. Then October 23rd, they came out, said that the term repos were going from 35 to 40 straight to 45 billion plus. And they made an amendment to the overnight repos going from 75 billion to 120 billion a night. As you guys know from watching my videos, the Fed came in initially. This was supposed to be a temporary glitch. Then they started allocating more and more money to it and spending more and more time. Now they've taken a step further, and this has gone from the shocking to the ridiculous. They've bumped the term loans from 14 days to some point all the way up to 42 days. We've got 28 days here, 42 days here. We'll put up a table right now. This is the Fed's projections of what they'll be doing in the term repos in the near future. The billions of dollars on this side have stayed relatively consistent. We've got 35 billion, 25. Down here we've got 15, 35, 35, 15, 35, and 35. And what I think is absolutely amazing, if you scroll down to the bottom of this page, you see on the Fed's website, it actually says, there's that little logo that says report a fraud or a scam. How about the Federal Reserve? That's the biggest fraud, the biggest scam I know of. It's crazy, you just can't make this stuff up. So I don't know for sure, but if I had to guess, I would say that the reason the Fed is doing all this is because it's a covert operation to paper over or to conceal the insolvency of one of the big banks or multiple banks. We're going to go over the numbers, which you will be shocked to know have increased dramatically. Then we're going to go over why the Fed has increased those numbers. December 13th to December 30th, they're going to inject $120 billion a night at a minimum. December 30th to the 1st or the 2nd of January, they're doing a one-day settlement repo. I call this the SBZR, which is the Special Bonus Zoltan Repo. Moving on to December 31st to January 2nd, $150 billion a night they're committing to. The 3rd to the 14th, they're going back to a meager $120 billion a night. So why are they doing this? Why have they upped it from 120 to 150? And why are they doing the Special Bonus Zoltan Repo of $75 billion? And I want to point out one thing, that Zoltan's report came out on December 9th. And if you didn't see that video, check that out. But the Fed's new report on the changes that they're making to their repo transactions came out December 12th. So what this means is it's blatantly obvious that the Fed is behind the curve. And that is the one thing that Zoltan and Jeff Snyder both agree on. It looks like right here that they're just getting their cues from Zoltan's report. Let's check out the mortgage-backed securities used as collateral in today's repo market. And the Fed, fortunately, has this on their website. What I did is had Sebastian aggregate all of the data so we could see if there's been an increase in mortgage-backed securities repos since September. And this is information you will only get on this YouTube channel. And thank you to Sebastian too. This was a lot of hard work. What we saw is the amount of mortgage-backed securities being used as a percentage of total repos since September has gone up by 30%. This supports exactly what Jeff Snyder was saying. Why? Now that there's an indiscriminate lender in the repo market, all of the financial institutions that need that cash can use the toxic assets that they have on their balance sheet. That's why we're seeing the amount of mortgage-backed securities used in repo increasing dramatically. So has the amount of mortgage-backed securities being used in the repo market increased? Well, September through December, the percentage was 23%. In January, that percentage increased to 42%. The last 3 days the repo market has been open, the percentage has increased to 54%. And Friday, it increased to 78%. This shows us that the repo issues not only include counterparty risk, but as Jeff Snyder pointed out, collateral. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.